Usually you think capital is very plentiful in advanced economies like the United States and Europe, and so money should be flowing from the advanced economies into the emerging markets. You hear so many people say, diversify your portfolio and you should go to emerging markets because that's where the growth is, that's where the opportunities are, right? Well, one of the things that Mike has always stressed, money follows profits, and profits follow productivity and technology. Where are the biggest boosts to productivity in the world? Where are the biggest changes in productivity taking place? The advanced economies. How many people, when they graduate college, want to work for the Zambia computer company?
Let's move on and double click on the money movements. Asset allocation. Let's start with the geographical or geopolitical allocations here. Emerging market versus advanced market. I remember, Bill, you mentioned Lucas paradox as well. What's your view on our capital flow in emerging market versus advanced market?
Yeah. Capital markets are really quite funny. As I said, Mike Milken built his entire life reputation on making capital markets work better. But there are different ways of moving money. There are the bond markets, the equity markets, and there are banks. And I think that's really the key difference, is that banks decide on who to lend to, right? Capital markets, right? You issue a bond and people buy it. You issue a stock, people buy it. Those two channels are really important because when you look at capital flows, it's supposed to be where capital is scarce, right? The returns should be high, and where capital is plentiful, returns are low. Usually you think capital is very plentiful in advanced economies like the United States and Europe, and so money should be flowing from the advanced economies into the emerging markets. You hear so many people say, diversify your portfolio and you should go to emerging markets because that's where the growth is, that's where the opportunities are, right? Well, one of the things that Mike has always stressed, not only in our calls with investment officers, but in general, he said, money follows profits, and profits follow productivity and technology. Where are the biggest boosts to productivity in the world? Where are the biggest changes in productivity taking place? The advanced economies. How many people, when they graduate college, want to work for the Zambia computer company? Nobody does. Everyone wants to work for Google, and everyone wants to work for Amazon. They want to work for web services. They want to do data, to become data scientists. The advanced economies are the sources of productivity growth and sources of profit. And so money flows not from the advanced economies to the emerging markets the way you would think, but rather from the capital scarce economies into the capital rich economies, because the capital rich economies is where the biggest profit opportunities are. That's what an observation that Professor Robert Lucas in the University of Chicago made back in the 1990s. And ever since that, people have been trying to figure out, why is it that Lucas paradox is taking place? Well, because investments are safer here, the facilities are better, the institutions are safer and sounder, I don't have political risk, a whole bunch of reasons. But the fact is, money is moving from emerging markets into the advanced economies. So that's the nature of the problem that people are trying to understand. And when you're allocating capital, right, you have to take that into account. And so when you say, I'm going to go emerging markets, you better have a darn good reason.
Perhaps.
I have one concrete example that proves that Bill is right. In Europe, there is a tiny country called Estonia. It has only 1.3 million inhabitants. It's bordering Russia to the east, Finland to north, and then the Baltic Sea to the west, and Sweden. 1.3 million. They have the most unicorns per capita in the world. The most digitalized country on this planet, and there is a massive capital inflow, not at least from Japan and from Asian capital institutions, because they realize exactly what Bill was saying. So in practical terms, you are right.
I thought you were going to mention Denmark.
Oh, well, that's the same. That's
one diet or fat-reducing drug companies worth more than Samsung Electronics today.
Absolutely. I mean, the most valued company in Europe is a Danish pharma company, which people are not aware of.
Just a random question, but what if all the money's already there? I mean, if it's all priced in, maybe then more opportunity in the emerging markets, maybe?
China is a good example. You've had a stream of CEOs going to China. Jamie Dimon, Bill Gates' former CEO, Elon Musk, and everyone has gone to China and said, we are in China, we are here to stay in China, we are here to build up the productive capacity of China, okay? Everyone is promising to be in China. You got to ask them the question that no one asks, which is, where are you putting your next investment dollars, right? Are you going to add more to investment in China when you are being told that if you are a high-tech company like Alibaba and Tencent, you may not be able to survive as you did before because you got too powerful and you're threatening the central control of the government? Many of the consulting companies that help foreign investors do due diligence by providing information and investigative reporting of investment opportunities, they get shut down because they're threatening state security. These are the things that are risks that are emerging in China. And so that's one example of where you ask the question, even if you are in that market, are you going to put more money in? And right now, so much of the conversation has been not so much are you in China or out of China, but in general, is China investable? Or would you take advantage of the trend that's going on now, even with Chinese manufacturers, leaving China and going to alternate sources of supply for the rest of the world? That the globalization stage 2 is going to be more regional centers, more replicated supply chains. And to quote my former boss at Citi, Jane Fraser, who at our Milken conference said, ESG, all that discussion, we're missing a couple of S's: safety, soundness, security, right? These are factors that we need to bring into portfolio allocation considerations. And when you do that, the question now becomes, are you really going to put more money into that one location, or are you going to start diversifying?
Don't like China. In fact, in terms of the money movement, there's like over 2,000 family offices that popped up in Singapore, and there's a whole bunch coming to Korea apparently already. In the Lotte building, there's a handful of Chinese family offices starting. So you're right, the wealthy in China, regardless of what others do, want to invest elsewhere. So if my kind of simplest naive expression is, if they don't want to put money where in their own country, why should I? So I've stayed away from China. I've moved to Japan from April this year, unhedged, unfortunately. So taking a little bit of lick on currency, but hopefully we're just going to get to it and stabilize the yen around 120, 140. I made that statement and it got to 147. So here we are.